Hey everyone, me Kevin here. In this video, I'm going to talk about a massive change coming and how I'm planning to invest in this massive change. And it's pretty complicated. Hey everyone, me Kevin here. In this video, I'm going to talk about a massive change coming to investing in our country over this next decade. Hey everyone, me Kevin here. In this video, I'm going to talk about some massive changes coming in our investing futures, and I want to start working on. Hey everyone, me Kevin here. In this video, I'm going to break some massive changes that are happening, and they're going to affect all of our investments, not just over the next few weeks or months, but over the next few years to decade. And I'm going to talk about all of it and give you a sneak peek on all of my research right here in this video. In my opinion, this is pretty wild, pretty overwhelming, and this is definitely a video worth watching all the way through. All right, folks, let's get started on this one. And if you like it, make sure to share the video. Let's start by focusing on the micro, which is what happens next week. Next week, the Federal Reserve will decide whether or not to taper in September. We don't actually expect them to taper here in September. We expect them to announce a taper maybe in the November meeting, which happens November 4th, or potentially they'll kick the can down the road to the beginning of next year. But while the market is so focused on the Federal Reserve tapering, they're kind of missing the bigger taper that's actually coming and the hammer that this is going to hit us with. But then this hammer and real taper is potentially going to open up some really unique opportunities, and that's what we're going to talk about here. So while markets right now are heavily focused on the Federal Reserve and whether or not the Fed's going to reduce their bond purchases of mortgage-backed securities and treasury bonds to sort of print essentially $120 million into the market, markets are forgetting that we've got a massive fiscal cliff that we're facing. And I'm not talking about the debt ceiling. I'm not so worried about the debt ceiling. The debt ceiling limit is something that Congress bickers about every single year, and they always threaten shutdowns. In the past, we've had shutdowns, but they tend to be more temporary anxiety events than anything else. We end up getting things dealt with anyway. But what's more important is the fact that we're going to hit a very big shift in fiscal spending, and again, this is going to give rise to some really unique opportunities. Take a look at this particular chart right here. This chart is a chart by Bloomberg, and it shows us in blue the fiscal policy impact of what the Federal Reserve has been doing. So if you look right after 2008, you see the bottom bar there, 2008, you'll see our federal government, this is not to be confused with the Fed, our federal government, Congress, printed money, stimulated the economy between 2008 and about 2011. Then they started tapering and withdrawing their support for the economy in 13 and 14. You see that with those negative blue lines there. And there wasn't really much support needed between 16 and 18, though we did have a little bit of bumps in monetary policy, like interest rates were bumped up. But Congress didn't really have to support the economy that much between 2015 and 2018, right? Well, take a look at this. When the COVID recession hit, look right here above my head, when the COVID recession hit, the federal government, Congress, printed a ton of money. And that helped us lead to this crazy frothy stock market that we have now because a lot of people had extra money. The stimulus hit the economy like crazy. And we saw some of the biggest record earnings that we've seen at companies like Apple, Google, Netflix, I mean, you name it. And the amount that these companies have shot up in valuation has just been nuts, but somewhat justified because of all this crazy money printing. It's almost like it's flown directly into stocks. But look what happens next year. And I shouldn't necessarily just say money printing because this money printing led to Congress spending money in a stimulative effect, right? Fed printed money, and then the federal government spent that money on stimulus programs. But the federal government is not slated to do that anymore. In fact, look at the future here, forecast by Bloomberg. Big old red negative forecast of US government spending. Now you might be thinking to yourself, wait a minute, Kevin, we have a $3.5 trillion Build Back Better plan on the horizon. Isn't that like an insane amount of extra stimulus? Yes and no. It's stimulus of $3.5 trillion, yes, over the next 10 years. Remember when we did the multi-trillion dollars of stimulus right here above my head? That was instant. We said in Congress we're going to spend trillions of dollars, and we did. Here's PPP, here's EIDL, here's unemployment, here's stimulus checks. That money hit our bank accounts fast. the $3.5 trillion Build Back Better plan is actually not something that's expected to really affect our money being distributed to our economy at all in 2022 or really even 2023. We're probably not going to see the effects of the Build Back Better stimulus until 24, 5, 6, when we actually start building out infrastructure. Sure, there are going to be small things like the child tax credit, but those little money sort of give outs by Congress are going to be vastly overshadowed by massive tax increases on corporations and higher income earners. Now, this video is not for making an argument for this Build Back Better plan, for taxation or against taxation. This video is about where do we invest going forward. And so far, what we have are estimates from folks like the Brookings Institute saying, quote, we're in for some very low growth rates in late 2022 and into 2023. Year-over-year comparables will essentially suck. The economy is potentially going to have periods of time where we have zero GDP or no annualized growth. Goldman Sachs has substantially revised down their growth estimates from 5.7% growth by the end of 2022 to just 1.5% growth. Why are they making these estimates? It's because of what's above my head, right here. Way less spending by Congress. And so if we have a stock market that's propped up on this kind of spending, and we're about to see here, the red part, way less spending, then we've got to prepare for the stock market potentially to trade sideways. This video isn't about calling for a big crash. It's about mentioning that, look, if we're going to have weaker comps with corporations, maybe we've got to open our eyes to other potential investment opportunities. That's what I'm going to talk about in this video. But the first thing I just want to put to rest, folks, it's inflation. Okay, no matter how long inflation actually stays here in the short term, the expectations are essentially the same for inflation. Look at this, folks. We know or expect, this obviously we can't predict the future, but no matter how long this bubble here stays high in terms of inflation, because we're somewhere right here right now at the peak of inflation, whether the peak ends over here or it ends earlier, later, whatever, does not matter. At some point within the next 2 years, probably within the next year, we're going to be at lower levels of inflation again. Supply chain shortages will clean themselves up. That temporary fiscal stimulus that we got is going to be gone. And look, even if inflation lasts longer, fine, it's still going to come down. If it doesn't last as long, it's also still going to come down. Either way, we expect inflation to go down, but we also expect GDP growth to go down. No matter what happens with inflation, GDP growth is expected to substantially decline after we came out of this crazy growth of basically printing our way out of the pandemic. So what do we have? We have a market where we know that inflation is going to go down at some point. Inflation, hyperinflation, is very unlikely to be a big concern for a long period of time. We also know that call options, longer-term call options, are probably going to suck in a sideways trading market. We also know that buy and hodling might end up leading to lower returns than what we've been used to in the future. Look, 2020 was great so far for indexes. Our indices, 2022 has been phenomenal. But we've got to start gearing for where do we invest for the year and how do we diversify into potentially where there could be mega leftover growth. Now, CNBC Pro has a suggestion for us. CNBC Pro suggests that maybe the place to invest is in sectors like real estate, healthcare, and utilities, because those sectors did really well since the last Fed taper and when Congress stopped stimulating the market as much or the economy as much by printing less money themselves. Well, maybe not them printing money, but rather spending less money, right? So less monetary stimulus, aka Fed taper, less fiscal stimulus, aka Congress passing less stimulus packages, right? And they suggest that in 2014, when we had this combination, real estate, healthcare, utilities, and IT did really well. And the things that actually lagged were things like cyclical growth and cyclical value. Now, just to give you a little bit of clarity what that means, cyclical growth would be things where people spend money. So think technology, think Etsy, think discretionary spending, right? Cyclical value are things like energy and materials, which have been doing well, but might not going forward. And so this is kind of interesting. They do actually even suggest that things like consumer staples did better, like investing in things like Target, Albertsons, Costco, Cisco, Hershey, Coke, Tyson Food. Those would be some consumer staples. Problem is, I agree that we're having this transition where At some point, we're going to have lower inflation, which is going to mean lower growth in the economy, which means we're not going to be going crazy to the moon on all the stocks like we have been. In fact, there could even be a spreading out of money, and maybe we just don't see those crazy rates of returns that we've seen in 2020 and 2021 going forward for the rest of the decade. Like literally 2022 to 2030 could just be a slow growth economy, putting along. And so I'm trying to determine where is something in this list where I have a lot of experience and we can make lots of money, almost for sure. I say almost because don't sue me, bro. But the answer is real estate. And now I know that sounds potentially boring to some of you, especially in the stock world, but I'm thinking about, and I'm not sure of this yet, I want to hear from you in the comments, I'm thinking about potentially creating a fund where anybody can invest in the real estate work that I do, so that you don't have to. I mean, you obviously can. Like, I got a whole course on my strategies. It's the real estate investing course linked below. It's next to Stocks and Psychology of Money. You could use that 40% off coupon to join those. You get all my strategies there. But I'm potentially thinking about using my expertise in real estate and buying real estate in a market where we just don't build enough homes, and we're unlikely to ever build enough homes. In fact, I just ran a political campaign on trying to build hundreds of thousands of new homes, and has basically laughed out of the discussion. I'm like, hey, we have a housing affordability problem. We should build hundreds of thousands of new homes in areas outside of our city so we can better our infrastructure, build solar and wind farms around them, build new master plan communities, and finally invest in our schools by raising more property tax revenue. That's logical. Logic doesn't work in politics. So this is where I'm interested in potentially creating a fund that invests, and I know some people are going to cringe at this, but hear it out, invest solely in California real estate, coastline real estate, where we can't build more real estate, and then potentially use some new laws that keep passing to turn these really good below market value real estate purchases into cash flow opportunities by doing very streamlined and simple redevelopments. And so this, if it is something that you are interested in, you can leave me a comment down below, but the best thing to do is go to metkevin.com/cashflow. metkevin.com/cashflow. And the goal is going to be, take a house, let's say, 3-bedroom, 2-bath house, buy it for, say, $550,000, put $40,000, $50,000 of work into it, so you're into it for, say, $600,000. It's now in a $700,000 to $750,000 neighborhood, and then we figure out, hey, can we work and partner with companies that can streamline, like even tiny home companies, that could streamline the conversion or replacement of our garage into a second unit, or a third or fourth unit? Because California just passed a law that allows you to turn one unit into not just 3 units, but 4 units, in some cases up to 10 units. And so now you insulate your purchases by buying real estate below market value. You could just sit on that appreciation and probably get returns in the neighborhood of 12 to 15% a year. But then if you could milk cash flow out of that on top, could be some interesting opportunities. So I'm exploring these. I'm not exactly sure structure yet or how, accredited versus non-accredited. I'd really like to open it up to everybody, but I'm thinking big ideas. And really, I know it sounds crazy, but because politics in California is so anti-growth and so anti-actually making progress, I'm like, wait a minute, this is literally perfect. If you can't have reasonable people elected in California, and they're not ever going to solve the housing crisis because they'll never get their act together and build more homes. And it sounds to me like the perfect thing to do is buy real estate in California. Now, I'm not suggesting you want to go all in on real estate, right? I'm 50-50. I'm about 50% stocks, 50% real estate. And I include in my stocks, like 10% of my stocks, close to like 4 or 5% of my stocks are cryptocurrencies. I put that in that lump, sorry. But anyway, to me, I kind of think everybody might want some exposure to California real estate. Now, I could be totally wrong, because I get it. Like, landlord-tenant laws are crazy in California. It's harder to get things done in California. But I've lived with it for 11 years. I've succeeded very well, but I've also failed really well. And the really good thing about that is I know how to screw up, which means I won't screw up. And I also know how to do things correctly, which is like, that's almost kind of what you want. You want somebody who's failed, but also succeeded really well. So I'm kind of excited about this. I'm not sure, but if you're excited about that idea too, and something to potentially diversify into, metkevin.com/cashflow, link down below, and stay tuned for more updates. So some thoughts. Hopefully, if you got value out of this in terms of the market, the direction of the market, direction of stocks, and potentially this diversification idea, share the video, like and subscribe to the video. The more people that sign up is actually better. Okay, so this is why you don't want to keep this like a big secret. Share it, because the more sign up, especially the more who say they're interested in investing sign up, the more quickly something like this can get done and put together, and the more scale and better leverage we can take advantage of. There's some really safe and good real estate leverage opportunities we can take advantage of. So anyway, I'm excited. If you're excited, mettkevin.com/cashflow. It really is interesting to me how it ties into the greater theme of where we're going in the potential market and slower growth in stocks. And this is why I've always had my real estate and stock diversification. But I know it's harder for other people to have that same diversification. I still encourage everybody to buy their own home. Don't get me wrong. Like, by no means I'm like, don't buy a home, just invest in me instead. Like, I will never do that. Please buy your own home, get into your own real estate. But I know there are a lot of us who are just like, yeah, I'm just not going to. So anyway, if you like this video, like, subscribe, share. Thank you so much. And folks, we'll see you in the next one. Bye.